Welcome everyone, Doug McKay, anti-wallstreetguy.com on late Friday afternoon, the 15th of June, 2012. Pretty much as always, we'll start out looking at a chart of the S&P 500. This is a daily chart, so the candles represent days. These are some posts that we put out this week. We were potentially looking at a bullish inverted head and shoulders forming, with the left shoulder being here. This is the neckline, then this was the head, or is the head, and then the potential of a right shoulder building out where we would want to hold kind of this 1295, 1290 area. Confirmation that we were going to go higher, that the market was going to go higher based on probabilities, would be a breakout of this channel, which would also put us out of and above the neckline. That happened today on higher volume. Obviously, a lot of this volume had to do with quadruple witching, option expiration. But a chart is a chart is a chart, and the price looks good. So we have the trend going from the 7th of, or actually the 4th of May, which was neutral to down, to now neutral to long, meaning bullish. Probably not an all-in situation. We would like to cost average in. As we get more follow through, that's when we want to add. And as I had mentioned to the subscribers, if it all blows apart, we would want to exit. But anyway, that's the S&P 500. What's up next, no one really knows, but based on the charts, we're looking at resistance at the 50-day moving average here. The fact today that we got above 1340 was a good sign. Not only did we clear the neckline that I drew in, but we cleared these highs here on a close with volume. All right, so that's that. The trend is up. We'll see how long it lasts. Often in the summer, the breakouts are more likely to be false breakouts, but we'll see. There's always exceptions to the rule. When we look at, we're going to pull up a couple different charts tonight, actually quite a few. So we're going to go through these kind of quick, and if I go fast, you can always replay the video. This is a chart of the NASDAQ 100, the Qs. I'm not as excited about this. I think Sunday on the Anti-Wall Street show we'll talk about it still being a mixed market. No follow through here yet above resistance and above the neckline. So I'm more partial to the Dow right now and the S&P. Here's a chart of the Russell using the ETFs. That is the Russell 2000 IWM. Same thing. Probably run into a little bit of resistance just above this high in the candle today. And we have yet to clear this here. So again, I like the SPY. I like the Dow, probably the best. The diamonds, again, we drew this chart in earlier in the week. And the reason for that big move today and now recapturing the 50-day moving average, a lot of that had to do with IBM. But the chart on IBM is very similar to what we're looking for, and what we have been looking for potentially this week, and that is the follow through of either a semi-cup and handle or inverted head and shoulders. We have the same thing here. If this is the neckline, we see a left shoulder here, again inverted upside down, a head here, a right shoulder, and then follow through. But this was the main reason that the Dow did the best today out of the four indices, primarily because of the weighting of IBM. All right, let's take a look at the financials. Transports don't look as good as the financials, but the financials, again, a decent looking chart. When we do look at the XLF, I'm sorry, the IYT, you're going to see that that's still not quite above the area of resistance. Let's take a look at Apple. Again, we're going to go through these kind of quick. You know, this could break either way. And my point of tonight's video, other than confirming the breakout out of the above the neckline on the inverted head and shoulders on the S&P and the Dow, is again to illustrate that it is a mixed market. Some stocks are working, some stocks aren't. Here's an example of Qualcomm. And whether it be the Nokia news or whatever, again, a chart is a chart is a chart. This is broken down. So if we see something similar to this occur in the S&P 500, we're just going to have to exit, even if that means taking a loss and sit on the sidelines till we get the confirmation of an uptrend again. So we always want to have an answer to the what if. Let's take a look at gold, GLD. Okay chart. Not all that excited about it. Again, this is so news driven, even more so than equities. But nonetheless, if we had to pick, a trend here, it would be up. We're above the 50-day moving average, and we're off those lows. But more confirmation would be close through 160, 162 resistance. I think that's probably where it's headed, but I would fish elsewhere. But if you're in this, I would have my stop probably just under 153. And let's take a look at bonds. Now, there have been times this year where both bonds and equities have worked, and now is that time. And we say this each week where everybody says that treasuries are extremely oversold, that are overbought. That may be the case, but the trend has not broken. So until we see something technically, there's no reason to get short bonds other than pure speculation. And there's TBT right there, double short the 20-year. And that seems to be rolling over. We'd probably have to get a close above 16, which would probably mean weakness in the IEF. Let's see. I think we looked at the Russell, right? If not, we'll look at it real quick. I don't think we did, but maybe we did. There's the Russell there. We'd really want to see this close above this area, certainly above that 77.45 level. I think we did look at that. Let's take a look at Under Armour. And I think we brought this up last week. If not, we'll cover it again. Maybe I'm thinking about it in terms of a still chart. But this is a chart that we put up where we want to trail 5% here, which means you would have been stopped out. But you have to have a short memory, whether it be a winner or a loss. So this is a situation where we got back above resistance, and therefore the odds or the probabilities were on our side that it was going to continue to break out. You're only going to hit resistance so many times, just like support, as we always say. So nice chart today, up 4%. And again, we like to date these posts. Let's take a look at Berkshire. We put this one up, the B shares, on some still charts throughout the week. Pretty decent day today. It was up. It was actually beating the market this morning. But nonetheless, this is another one of these charts where we said if it took out this low, we would exit, and we would have taken a loss there. But at the same time, very similar to Under Armour, if we would have seen it come back up, and let's say clear 81.30, we would have got long again. And that's not day trading. We're simply just looking for trends here. Sometimes the trends last for days, sometimes they last for a week. The market will dictate that. Let's take a look at Home Depot. These are just some stocks I'm going to look at next week for the managed accounts. We still want to see a close above this line here, but I do like this chart. Little sloppy and loose in here, but we'll take a look at it next week, especially if we get above the line here. We don't want to chase anything. We're looking for everything or anything that's breaking out of basis, preferably with volume. This is a chart we put up earlier in the week, or not too many days ago, 13th, a couple days ago. JP Morgan, again, a chart is a chart is a chart. Left shoulder, head, right shoulder, at least that's the way I see it. Neckline, above the neckline, it's a go. Potentially it's a go because we're going to fill these gaps. I'm not quite sure this gap has been filled yet or not. But if it gets through that, who knows? Maybe it's going here. Let's take a look at the dollar. UUP. I would really like to see the dollar bounce, but this chart, again, chart is a chart is a chart. We got 4 down days in a row because of the euro. This 50-day moving average, the blue line, could be a magnet. I'm not sure this gap was ever quite filled. Certainly this gap, we can just eyeball it. See, that wasn't filled. So we may be headed there. And more often than not, like we always say, where a symbol breaks out is typically where it is retested again. So it broke out here, didn't quite retest it here, but maybe it's coming back down to retest it. Let's take a look at GE. We did look at the XLF. Decent looking chart. Not a big fan of the company anymore, but good looking chart, especially once we got through 1950. So any of these stocks that are breaking out, maybe you want to give them a chance to fade. If you really like it, put a half a position on. And again, if it all comes apart, keep your eye on the 50-day moving average. If these stocks are trading below the 50-day moving average or the indices, very similar to the SPX, S&P cash, then keep an eye on support, which in this case for us would be right around that 1290 level. Let's take a look at UYG, which I think is just the financials on steroids. But again, very similar chart to the S&P, right? Where we broke the neckline intraday on Monday, came down. I thought if we were possibly coming back down, to be frank with you guys, to fill this gap, both on the S&P, UYG, and any other chart that looked like this. That has not occurred. Maybe it will occur at some point, but that's tomorrow's news. So what we want to look for now is what's happening in the moment. And again, this is a chart that's breaking out, and that is Ultra, the financials. All right, you guys, that's it. Doug McKay, antiwallstreetguy.com. We'll finish up with the S&P. Who knows? Maybe we stop at 1344. Maybe we go to 1400 and change. Maybe we get through the 1420 highs. You know, a couple months from now, we could be at 1200. We could be at 1400. That's what makes the market fun. Interesting week next week. We all know that. Maybe we'll finish up with the VIX. I haven't looked at this in a while, the actual VXX. So VIX is getting low, could go lower, which means we have more room to the downside in the VIX, which would mean more bullish news for the bulls in equities. All right, you guys, Doug McKay, antiwallstreetguy.com. For the record, for the first time in a while, we have the overall trend as neutral to long. That means we're not buying with both fists. But we're stepping in on the long side and or adding to our longs, and we'll let price prove itself. As it proves itself with volume, we will add. You never want to cost average down. You want to cost average in. Okay, happy Father's Day. We'll see you next week.